Dear Professor Stiglitz, dear colleagues, ladies and gentlemen, welcome to the University of Zurich. As president of our university, I have the privilege and honor to introduce today's speaker. He is a person who doesn't really need to be introduced, but nevertheless, let me give you a few words about Joseph Stiglitz, professor at Columbia University. He is one of the most influential economists of our times and well known far beyond the academic community, as the presence of so many people not only in this room but also in the 3 rooms where we're beaming this presentation is demonstrating. Joe Stiglitz was awarded the Nobel Prize in Economics in 2001 for laying the foundation on the theory of markets with asymmetric information. He figured on the 2011 list of 100 most influential people of Time magazine. He has received more than 40 honorary doctorates, 40 honorary doctorates from prestigious universities, among them universities of Cambridge and Oxford. And his list of publications is really very extensive. He has more publications than many other people have citations. He has also written several best-selling books. I haven't had the pleasure of meeting Joe Stiglitz personally until today, but from my brief conversation with him, it is clear that he has inexhaustible energy and a great passion for what he does. Joe Stiglitz has climbed the heights of what an academic career has to offer. Educated at Amherst College, a small, outstanding liberal arts college in Massachusetts, receiving his PhD from MIT, he became professor at Yale when he was just 27 years old. Stanford, Oxford, and Princeton were further stations on his academic path before he joined Columbia in 2000. Joe Stiglitz has not only fundamentally influenced his own discipline, economics, but he has also contributed substantially to shaping the world outside academia. He has for years been a sought-after government advisor in many parts of the world. He served, for example, as chairman of the Council of Economic Advisors during the Clinton administration. That would be the first Clinton administration. And he was chief economist of the World Bank from 1997 to 2000. In these positions, he was at the front lines of economic policy worldwide at a time where globalization was getting up to full speed. More recently, he advised Scotland on its economic future, as well as Greece at the heights of its economic and financial crisis. An outspoken critic of international economic policies and the institutions that enforce them, Joe Stiglitz has throughout his career fought tirelessly against economic orthodoxies and the growing inequality of society. He does believe in the reconcilability of economic growth and fairness, and has been described in a headline as a tenacious optimist. In recent years, he has written extensively on issues connected to globalization, inequality, and poverty, and the economics of climate change. He is, in a unique way, qualified to address the topic of today's lecture, climate change and financial complexity. In this lecture, he will explore the role of the financial sector in the transition to a low-carbon economy, or at least that's what we expect of you. You can still write a few notes on your slides there. Former UK Prime Minister Gordon Brown characterized Joe Stiglitz in a portrait as a brilliant intellect and a great conversationalist, whose work goes on challenging us all to rethink our ideas. Ladies and gentlemen, I am very much looking forward to this talk. Professor Stiglitz, thank you very much for stopping in Zurich on your way to the WEF and for sharing your thoughts with us. I know that this is not the first time you stop here in Zurich. It's not even the first time you stop in advance of Davos. 2004, you already were here at the university talking about governance for a sustainable world. And I think the crowd here shows that we should perhaps have a more sustainable relationship, and we look forward to inviting you again next year. I heard that Joe Stiglitz was one of the most regular attendees at the WEF. He almost has the medal as the longest serving invitee there. In this vein, ladies and gentlemen, I thank you for your attention. I wish us all an intellectually stimulating and enjoyable evening, and I now hand over to Professor Battison, who will moderate the event. Thank you.
I won't take time to Joe's talk. I just want to introduce myself. My name is Stefano Battistone. I'm professor at the Department of Banking and Finance, and we're really honored to have Joe today talk about this challenging topic, and which is something that our university, in particular our department, is somehow already active into. I will be moderating the question and answer session later on. We are looking forward for an interactive session at the end of Joe's talk. Joe, the floor is yours.
Well, it's a real pleasure to be here again. As was mentioned, I've been going to the World Economic Forum now for a very long time, since about 1995. So I'm almost, have seniority, almost tenure. One of the reasons I go there is one of the themes in recent years has been inequality. And one of the problems of the World Economic Forum is that they only had rich people and they wanted some diversity. So I represent diversity. The issue of inequality has actually been highlighted in recent years in the World Economic Forum, and Oxfam came out again this year with their statistic about a simple number describing how much inequality there is in the world. And it's been getting worse. The way that they describe it in very graphic terms, they ask is, how big of a bus do you need to have as much wealth as the bottom 50% of the world? And the bus used to have a little less than 90 people. So a bus of 90 people, most of whom are in Davos, have as much wealth as the bottom 50%. But you might say, good news from the point of view of the people in Davos is this bus keeps getting smaller. So that now the bus only has to have 68 seats to have as much wealth as the bottom 50% of the world. It's a striking statistic about what has been happening in our world. But I'm not going to talk about that. I'm going to be talking about another problem that the world faces, which is climate change, and the relationship between climate change and finance. So there are two themes that I'm going to address this evening. One of them has to do with macroeconomic behavior and climate change. The idea is that retrofitting the global economy to respond to climate change will require large investments. Question is, how are you going to finance those investments, and what implications will that have for the macro economy? The second theme really is more on the theme of financial complexity, and that is the following. The changes in asset prices associated with climate change will have very large and quite complex repercussions for our entire economy, in particular for our financial system. There will eventually be a price of carbon. I feel very confident of that. One of the outcomes of the Paris meeting was, the Paris meeting was for some people's purposes, a disappointment, because they had hoped that there would be a price of carbon. A price of carbon would incentivize people to economize in carbon. But given that one of the major parties in the United States isn't sure whether climate change exists, it's difficult for the United States to succeed in participating in a meaningful agreement. So you have to view Paris as the best that one could get out of a bad global situation. And I think it achieved, it was an achievement. What they did is really continue the momentum in, and you should put everybody on notice that there will be a price of carbon. Whether it'll be in 5 years or 15 years isn't clear, but there will be a price of carbon. The point that I'm going to be trying to emphasize here is exploring some of the consequences of that. The price of carbon, the fact that carbon will have a price, will have very big effects on the prices of various kinds of energy. Carbon energy, coal, oil, gas will come down, and other kinds of energy sources, the value will go up. But it's not only the direct effect, there will be large numbers of indirect effects. Housing that is and real estate that is carbon inefficient will have the price come down. So there are going to be a large number of changes in asset prices, and these changes in asset prices in turn will lead to large changes in prices of corporations, prices of financial institutions. And so this is going to be a very dramatic change in the prices that characterize our economy. And if these changes happen very rapidly, it could actually pose systemic risk for our economies. So one of the themes I'm going to be talking about is the importance of trying to get a hold of and assess these changes, and I'll talk about some aspects of that in the second part of my talk. So first, let me talk about the macroeconomics. Now, you here in Switzerland probably don't really appreciate what I'm about to say, but the global economy is not in good shape. You have too low of an unemployment rate to really appreciate the suffering that is going on in the rest of the world. There are literally, since the beginning of the 2008 crisis, there are more than 50 million people have joined the ranks of the unemployed. The Fed announced that there was a recovery, but I was in Jackson Hole this summer where the heads of the central banks come together every August. And I was with a large group of, you might say, protesters from a truly diverse group of Americans. And they weren't allowed to, even though we have free speech, we don't allow people to carry signs. So they had to wear T-shirts. And their T-shirts basically said, "Whose recovery?" The fact was that for African Americans, for Hispanics, there's not really been a recovery. Their net worth is lower than it was 20 years ago. Their income is lower than, median income, half above, half below, for a full-time male worker in the United States is lower than it was 40 years ago. Wages at the bottom in the United States are lower than they were 60 years ago. So an unemployment rate among African American and African American males is very high. So they were trying to convince the Fed that this notion that the U.S. economy is recovered it may be true if there's full employment among the friends of the people on the Federal Reserve. But that's not saying what's really going on in our economy, and that, and so we were saying, you know, who's recovering? Well, the problems in the United States are actually mild compared to Greece, Italy, many of the other countries in Europe. And so what is true, you know, 7 years after the recession began in 2007 in the United States, the global economy is still weak. And the question is, what is going on? Well, that's not the subject of my talk, but the basic point is that the central problem facing the global economy today is lack of aggregate demand. And if I had more time or different, I could try to explain why there is this lack of aggregate demand. But what I want to talk about is the obvious answer. There is a very easy way of increasing aggregate demand, and that is retrofitting the global economy to face the challenges of climate change. If we had had a carbon price that would have induced people to make investments to retrofit the economy, it would have stimulated the economy, that would have improved growth and employment. And that would have in turn had first-order effects, significant effects on employment, on inequality, because one of the reasons that inequality has been growing, that bus keeps getting smaller and smaller, is the fact that the unemployment rate is so high. That has a direct effect on inequality, has an indirect effect because it means that wages don't do well when the level of unemployment is low. And it has an indirect effect because austerity, government spending gets cut back, and this is particularly important for ordinary individuals and for the poor. But that raises the question, even if we had a carbon price, how can we finance those carbon investments? Well, it's actually interesting. Many of you may not remember this, but for Americans, this was a very big thing. Before the crisis, Ben Bernanke, the chairman of the Federal Reserve, gave a famous speech in which he tried to shift blame for the weak economy and for the crisis that was about to happen, to shift blame to China. He said the problem was there was a savings glut. And when he gave that speech, my reaction was he must be living on a different planet than the one I'm living on. So he said there's too much savings going on. And what I observed as I traveled around the world was that there was a huge need for infrastructure investment. Even in New York, anybody who comes and visits New York knows that we need a new airport. We need roads. If you visit New York and your back still survives, you have a strong back. So anyway, it was very clear that there was a huge need for infrastructure investments, but in particular, there's also a huge need to retrofit the global economy for climate change. And the investments needed are huge. So the problem is not that there was a savings glut, that there was too much savings. Actually, there's a shortage of savings. The real problem was that the financial system was not performing the important functions that it's supposed to perform in bringing together the savings and the investment. Economists refer to this as intermediation. There's been a lot of discussion in the last 7 years about regulating the financial system. But it's interesting, most of the discussion in regulating the financial system has been focused on one issue, trying to prevent the financial system from imposing harm on the rest of our society. It's been focused on excessive risk-taking that could cause another crisis, focused on issues of market manipulation, issues of insider trading, a whole set of issues of abuses of the financial system. But there's been very little discussion of the other side. How do we make sure the financial system does what it's supposed to do? And one of the things that the financial system is supposed to do is intermediate between savers and investors, to bring together the people who have savings and the investment needs. But the global financial system didn't do that very well. It would be obviously something very strange if the best use of global savings was building shoddy homes in the middle of the Nevada desert, which is what our global financial system did. So that's just a sign that something was not good about right about the way our financial system was working. And the failure to do this obviously has long-run consequences. Actually, the puzzle of the failure of intermediation is both understandable but deeper than that, because the investment needs of the world are long-term. In particular, retrofitting the world for climate change is a long-term investment need. And many of the sources of savings are long-term. The sovereign wealth funds, pension funds are thinking about long-term. But in between these long-term investment needs and the long-term savers are short-term financial markets, focusing on quarterly returns. And obviously, if you have between these long-term investment needs and long-term savers, short-term financial markets focusing on the quarter is long-term in terms of, the nanosecond is what we're now working on. Obviously, things are not going to work well if between these long-term investors and long-term savers, you have these short-term financial markets. One of the interesting things is that this has finally become a major issue in the United States, where unfortunately we've had inordinate influence on the rest of the world. We've encouraged the rest of the world to move towards this kind of short-term thinking. And one of my more recent books called Rewriting the Rules of the American Economy, an Agenda for Shared Prosperity, has been to try to understand how it is that our financial markets wound up being so short-term. What are the aspects of the rules of the game that we devised that led to this increase in short-termism in the United States? But this is now, the good news is this has now been taken up in the presidential campaign, and at least one or more of the presidential candidates are now talking very explicitly about how do we reform our financial markets to make them more long-term. Well, the good news is that while the market has been slow to respond, and we've not been able to change the rules of the game, the legal framework, in ways that will lead to long-term yet, there is a beginning of some institutional reforms that are actually moving, that are helping fill the void. And I mentioned two here. One is the BRICS Bank, the BRICS, Brazil, Russia, India, China, and South Africa, which I was just visiting in Shanghai last week and was very involved in the creation of this bank, and the Asia Infrastructure Investment Bank. Both of these banks are designed to try to encourage long-term investment. In particular, the BRICS is now, the bank is focusing on green investments. in the emerging markets and developing countries. And they realize that there's this lacuna, this gap in the private financial markets, and they're trying to step in to fill that void. I was in Addis Ababa this summer for a big UN meeting on financing for development, and they too talked about the deficiencies in the private market and the need for development banks like the BRICS Bank and the Asian Infrastructure Investment Bank to fill that void. And there are actually some discussions going on about creating new facilities both in the World Bank and a global infrastructure investment platform. One way of thinking about these institutions is that they can help recycle the surpluses, like the surpluses in China. They used to be almost $4 trillion. There's been a lot of money moving out in the last few months, but still, it's still around $3.3 trillion. And just, you know, those of you who aren't very much into economics, $3.3 trillion is a lot of money, even for Switzerland. The good thing is that some of this money, there are actually trillions of dollars in sovereign wealth funds, and many of these have a long-run focus and the short-run focus of private markets, and have more sensitivity to the social importance of climate investing. And so there is underway at least the hope that these will help provide some of the investment that would at the same time stimulate the global economy and help us get out of what people at the IMF have referred to as the new mediocre, and I've called the great malaise. Well, let me come now to the second part of my talk, which is climate financial risk. Here, just to repeat what I said in the beginning, if we are successful in limiting the increase in temperature to 2 degrees centigrade, we will not be able to use all the reserves of oil and gas that have already been discovered, let alone coal. That's a big deal. And what that means is that some of the reserves that will not be consumed will have zero value. If you own any of those, you should rush to sell them. These are called, economists refer to these as stranded assets. The market, though, has not yet recognized that they have zero value. The problem is that when the market discovers that they are worthless, there will be large changes in the values of the companies that own these assets. And, you know, there's a lot of discussion about markets being wise and far-sighted, but the evidence is very much that that's not the case. And of course, anybody who watched the 2008 financial crisis understands that they often don't see things coming until it stares them in the face. And any of you who doubt that should see this movie, The Big Short, because that is a much more graphic presentation of this than I can give in these PowerPoint presentations. The view is that markets have not yet fully taken on board the implications for climate change. Now, it's possible that the adjustments could occur slowly, but on the other hand, it is possible that the adjustments could happen very rapidly. And that's especially true because there's a phenomenon economists call herding behavior, where people get information, beliefs, by looking at what other people do. And of course, where do they get their beliefs? From looking at what still other people do. And that phenomena can give rise to crescendo kind of behavior where it cascades, where things happen very quickly. And of course, if that happened, if all that if all the adjustments happen very, very rapidly, there could be a financial crisis, or at least a very dramatic change. Now, there's some evidence that the market is beginning to realize the existence of climate risk. One example of that is actually inside many corporations, they're already using a climate price that they recognize. And this, one of the interesting things is, even oil companies, at least some oil companies, use a carbon price in making their own decisions, but they, of course, at the same time, they're arguing that there should not be a carbon price. So they've recognized the reality that there will be a carbon price. And some of them actually use a reasonably high carbon price. But there's another manifestation of this. By some accounts, the value of the reserves, overvalued as they are, exceeds the market value of the corporations that own them. And that's sort of a puzzle until you start thinking about the nature of how corporations function. If you're an oil corporation, what do? Well, most of the oil corporations are headed by geologists. And what do they like to do? If you're a geologist, what do you like to do? You like drilling oil wells. That's what gives you your kicks in life. You know, you like getting your salary, but what you really like doing is exploring and drilling a hole and seeing if you get a gusher. And if you do, it's really fun. So if you're an oil company, it's not very much fun to be an oil company and do nothing but take existing oil and pump it out. That's a boring job. So, and you don't want life to be boring. So what is going on is that the market is gradually realizing that there is what economists call an agency problem. The managers of the oil companies will dissipate the value as they continue to explore for additional oil that will never be used. Now, they've been woken up a little bit to this, and they decided not to drill for oil in the middle of the Arctic because it's very cold there and it's not fun drilling. And there's some other deep water wells that are, even if they discover the oil, the cost of extracting it is so high that it's very hard to justify. But so there's been some curtailing of drilling, but what seems pretty clear, given that we have more oil than we will be using, drilling for still more oil is a peculiar kind of economic activity. And at the very least, the marginal value of the discoveries are likely to be considerably less than the cost of exploration. So if this is true, this explains what we call the negative residual value of the corporation. In other words, the value of the oil is greater than the value of the corporation because the oil companies will manage to waste a lot of money. And there's actually a long record of oil companies doing this over the last 50 years. So market value maximization, which is what is taught firms are supposed to do, but they actually don't. If you were actually market value maximizing, there's a very simple thing that oil companies would do. They would shut themselves down and just become an operating company taking out the oil. But so far, not many of them have expressed interest in this particular idea. Well, the real challenge is to try to understand the highly interdependent financial markets. And here is the idea that banks lend to corporations, corporations own shares in other corporations. These banks and corporations have a wide range of interdependencies. some of this is with the producers of fossil fuels, and the decrease in value of fossil fuel companies with many bankruptcy will have systemic effects. But it's not only with the fossil fuel companies, it's with every other asset, because, for instance, real estate. There is some energy efficient real estate, and there's some real estate that's not very energy efficient. Once we have a price of carbon, the cost of transportation will change, and that will change the value of assets located in various different locations. The structure of our cities will change as we recognize carbon prices. So having a carbon price will have some very profound effects on all asset prices. But once you realize that the economy consists of these multiple interdependencies, people lending to each other, people owning assets in each other, in a very, I would say, not fully transparent way, very hard to calculate, means that there is going to be, that analyzing the systemic effects is going to be difficult, but it's also important. So this then relates to the broader research agenda that many of us are involved in network analysis, and what I want to do here is to try to describe this broad research agenda, give you a few results, talk a little bit about some of the other examples where this kind of analysis has come to the fore. So the importance of these kinds of systemic effects were exposed by the financial crisis. The most dramatic example was the bankruptcy of Lehman Brothers turned out to have systemic effect. When Lehman Brothers went bankrupt, the firms that had lent money to Lehman Brothers, who owned bonds of Lehman Brothers, they became bankrupt. But then those who had financial relations with those who went bankrupt, they often became bankrupt. So there was a whole credit chain of one bankruptcy leading to other bankruptcies. Now, it would have been far worse, except that in the end, the Federal Reserve intervened and stopped some of the bankruptcies by bailing them out. But what became clear was that in the absence of that intervention, there would have been these very complex interdependencies where it was not clear where the bankruptcy chains would end. But the fact that it wasn't clear what was going on also contributed to the crisis directly, because just to give you a flavor of what was going on, nobody knew what assets any bank had, because they knew that the bank was owed money and owed money to others, and it didn't know who was going to pay what was owed. And because nobody knew what each bank was worth, nobody was willing to lend to anybody else. And that was what contributed to the freezing of the capital market. So it was in part precisely because there were these complex interdependencies that the financial markets froze. What was really interesting is that the financial innovations that had happened in the preceding decade or so actually made the problem a lot worse, because banks had written credit default swaps, and the value of those credit default swaps depended on counterparty risk. One of the major players was almost surely bankrupt. Maybe more were bankrupt. And so people had bought, one way of thinking about it, people had bought insurance policies, but then you discovered that all the insurance companies might be bankrupt. So you didn't know whether you had insurance or not. You know, an insurance policy, if the insurance company is bankrupt, isn't worth anything. So, and this also has other profound effects that I'm not going to talk about, but I just mentioned. One of the big advantages of a market economy is supposed to be the decentralizability of the market economy. That you don't have to know all the information. But what our financial markets had done in the preceding decade or so is to destroy the principle of decentralizability. Because in order to know whether Goldman Sachs was viable, you had to know every other financial institution with which they had engaged in a bet, or a CDS, or a derivative, or a relationship. And then you had to know every other bank, Goldman Sachs may have had a relationship with Morgan Stanley, but then you had to know every relationship that Morgan Stanley had down the line. So we had destroyed one of the strongest arguments for a market economy, decentralizability, in the name of the market economy. In the claim that we were making the market economy more efficient, we destroyed one of the basic arguments for the market economy. So this is all part of what you might call the research agenda of trying to understand the interrelationships going on in the market. Had the Fed, for instance, conducted a network analysis, they would have realized that if they shut down Lehman Brothers, let it go bankrupt, it would have had systemic effect. But they had not done that. And it was remarkable because everybody in New York, at least, knew that Lehman Brothers was, with a very high probability, going to go bankrupt. And you assume that down in Washington, it's not that far from New York, that they also knew that Lehman Brothers was going to go bankrupt. You know, that's part of the Fed's job. And yet, they never looked into the systemic consequence of what was going on. Well before this, there have been some research that highlighted the risk of this network analysis, of how one bank could lead to the cascade to further banks. Interestingly, the basic intellectual framework, both of the Fed and the IMF, had taken a very different approach. And what they had talked, I see that I'm talking too long. But what? Okay, I'll try to go a little faster. Okay. They had used models where they emphasized the virtues of diversification. And the idea was if you spread risk, you split it up, and that meant the system was more stable. And even after the bubble broke, the housing bubble broke, Ben Bernanke was asked, was he worried? He said, no, the risks are contained because we have diversification. Now, after the crisis, with the IMF and others always talked about contagion. What was the notion of contagion? Contagion means that a problem can go from one country to the next. But these ideas of diversification and contagion are actually inconsistent with each other. They're a very different view. Think about it the following way. And the difference between contagion and diversification. Assume that 100 people were to arrive in New York exposed to Ebola. The diversification strategy would be you send 2 of them to each state in the United States. That's that was the recommendation of the Federal Reserve and the IMF. Now, the other strategy, if you think about it from the contagion point of view, you quarantine them, then you keep them all together. Okay? Well, I think we all know what the right answer is. Diversification is not the right answer. But that raises a very, very deep mathematical question, an economic question. When do we want to diversify risk, and when do we want to quarantine risk? That's a difficult issue. And you could only address that within the kind of network analysis. So what one needs is a coherent approach taking both sets of effects into account. And one can show that there is an optimal degree of diversification and the right form of diversification. So since then, there has been considerable progress in analyzing the impacts of network architecture, the effects of networks on systemic stability, the role of contracts, CDSs. Two important ideas are that privately profitable contracts may not be socially desirable, and excessive diversification may lead to an increased systemic risk. There are a number of other major insights from network analysis, so let me just describe them very, very briefly. First is that systemic risk can be measured and monitored with network-based indicators. To contain systemic risk, it may be desirable to limit interconnectedness, complexity, and correlations, and to construct a richer ecology of financial institutions, not just universal banks. And the second observation is architecture matters. Some architectures are better able to absorb some small shocks, some are more resilient to large and correlated shocks, some are more likely to give rise to bankruptcy cascades. And final idea is that circuit breakers can help prevent cascades, and capital controls can be thought of in an analogous way. Just to give you a little bit of let me just to summarize some of these in terms of some general principles. Systemic risk, in which there's a lot of concern, has actually increased since the crisis. And the focus in a lot of discussion of the increasing systemic risk is that actually, as a result of the crisis, there's been bank consolidation. So the problem of too big to fail banks has actually grown worse. But one of the things that this network analysis emphasizes is the problem of too big to fail banks is not the only problem. And but excessive focus on the too big to fail banks you can be too central to fail, too interlinked to fail, too correlated to fail. Another set of aspect of analysis is the extent of systemic risk is endogenous. That is to say, once you realize that the relative size of banks, the concentration of the banking system, the contracts between the banks, the extent of correlation of their actions are all endogenous. They're decisions the banks make. You realize that the systemic risk is endogenous, and that part of the problem is that the banking system has an incentive to make sure that it has excessive systemic risk, because with high levels of systemic risk, it knows it will be bailed out. Well, I don't have time to describe here. Just let me summarize. This article, this slide just emphasizes the fact is the financial system is a complex network, and that we've made a lot of progress in understanding both a whole variety of linkages, the role of capital controls, the role of clearing houses, and this allows us to better design policies that make the financial system more stable and better able to serve its financial functions. Let me just briefly describe some of my own interest in the topic, which actually predates the financial crisis of 2008. It actually goes back to the days when I was the chief economist of the World Bank, and it was a very exciting period. Again, it's much more fun to be chief economist when the world is falling apart. And we had nothing as good as the global financial crisis, but it was second best. We had the Asia financial crisis. And one of the really interesting aspect of it is that 70% of the firms in Indonesia went into default, and about 50% of those in Korea and Thailand. The problem was with every firm in default, it was impossible to know what the value of any firm was, because the major asset, every firm owed money to every other firm. But the firms that owed the asset, you couldn't tell whether they were bankrupt or not, because that depended on whether they got paid money that was owed to them by other firms who might or might not be in default, depending on whether the firms that owed them money went bankrupt. So it was an extraordinary complex general equilibrium problem that had not been solved. So it was actually, I can, here I was at the World Bank chief economist, and I realized that there was this wonderful mathematical problem, and the question was, did I save Korea or solve the mathematical problem? Well, I didn't do either. But the fact that you had this complex problem that was not easy to solve led to a paralysis. It meant that took years to resolve it. The delay in restructuring was extraordinarily costly. And it led us to some policy proposals, something called a Super Chapter 11, for dealing with it. So this brings me back to the theme of climate change. Climate change represents a new arena where network analysis will be essential. As I said before, the calculations are complex. Systemic effects are likely to be larger than the impact effects. There are lots of issues related to fiduciary responsibility. I've been arguing that that fiduciaries, those who are managing university endowments or foundations, should not be owning carbon assets, because you know that the value of the asset is going to go down. You can't tell when, but the market is overvaluing the assets. But now what you have to realize is it's not only the direct effect, but you have to actually calculate the second and third and nth round effects. The managers of funds, realizing there's likely to be large adjustments in asset prices in coming years, need to take precautionary measures now in adjusting portfolios. Not only divestment from carbon assets, but also asking what other assets are likely to be affected indirectly as the price of carbon and other prices adjust. So let me conclude. Seldom has there been an instance in which the world has been put on notice that prices are so markedly wrong. And when I say put on notice, with a very long lag. Back in the crisis of 2008, there were a few of us that were saying the price of housing in the United States was wrong. I should tell just a very brief little story. In 2008, in January, I went to the Davos meeting, the World Economic Forum, and the bubble had broken and the world was falling apart. And there were, it was very clear that things were going to get worse. They hadn't yet fallen apart, but it was so clear at that point that we were going south. And there were a whole group of central bankers who got up and said, after being criticized for not having done more to prevent this, a whole group of them, there were about 5 of them lined up, of central bankers, and said, who could have anticipated this? And then it was interesting because then there were another 5 of us on the other side who said, well, if you listened to us last year, you would have anticipated this. And we've been actually saying this for several years. But in fact, it was only for a few years. Carbon prices, the problem with carbon has been not a few years, but it's actually a very large number of years. So seldom has there been an instance in which the world has been put on notice with such a long time that prices are markedly wrong. Carbon price is now 0 or near 0, but in the not too distant future, carbon price is likely to be large. The sooner that this is recognized, the more quickly the world will move to a carbon neutral economy. But the more discrete the change in carbon price and the recognition of the fact that there will be a hard carbon price in the future, the more likely that we might face a financial crisis. In principle, the economy should be able to easily absorb the adjustment, but systemic risk analysis suggests that this may not be the case. And the second concluding comment is putting a price on carbon, I think, provides the best opportunity for the world economy to return to full employment quickly. In principle, there should be no problem funding the necessary climate investments, but institutional innovations may facilitate the transition. The major thesis of this talk has been the transition does pose systemic risk, and it's only through network analysis can we understand the nature of these systemic risks and take appropriate preventive actions. Thank you very much.
So, it's time now for the Q&A session. Let's maybe collect 3 questions and then have Joe answer. So, please.
Thank you very much, Professor Stiglitz. I have a question about the drivers in that bus and what direction they're taking. So my name is Falco Petzold. I did my PhD here with Professor Marc Genet at the University of Zurich, and as a result, I'm now a postdoc at Harvard, and I run a program exclusively for young billionaires that are interested in climate change, sustainability, and impact investing. What is your recommendation, what they should take, what direction, what action they should take now in that situation? I mean, I assume you will now say, of course, they should consider the carbon bubble and their investment processes, and they already do that. But what else can, people that are in that bus, very extremely wealthy individuals, now do to contribute to sustainable development with the power that they actually have? What would be your top 5 recommendations that I can take back to that constituency? Thank you.
Connected to the question, there's an interesting notion, which is the bus number, which is how many people do you need to shut down a project if a single bus goes out of the please, over there. So there's a question over there.
Let's get back to climate. If we want to work on the impact of climate change, then society must pay. And as soon as we have one index people start gambling on, and if we have different indexes such as carbon dioxide concentration, temperature increase, carbon price, and the number of storms, and then people will probably invest the money into gambling rather than the real purpose of coping with a climate change conference, the consequences. How would you avoid this diversion of financial resources from the real purpose to some people's money games? And is it unavoidable, or that's my question. Thanks.
Hi, thank you very much. That was wonderful. My name is Leslie Haroon, and I work with a new philanthropy focused on the issues that you outlined in your talk. And I'm just wondering, is anybody doing this network analysis of the systemic risk, and whose job is it? And if nobody's doing it, you know, how do we go about this? How do we start?
Okay, well, the answer to your question is Stefano is actually heading a research group here at the university trying to work on that. The general analysis of viewing things from a network perspective is a new field that has just been growing. As I say, that a few of us did a little work beginning in 2000 to, you know, after the East Asia crisis, you know, where it became the first time I think people began to realize how important this was. Data on these kinds of interconnectivity was not available. We did a project in 2007, and the only country that we could get good data on the pattern of connectivity and only was Japan. Now one gets a lot better data to see, and Stefano's been working with several of the central banks now. It's very interesting. There are big research programs, not on the climate change issue, but on the broader network issue. The Bank of England, Andy Haldane, who is the director, was the director of research, has been very active, and the ECB now has been doing a lot of work. It's interesting that there has not been the same engagement at the Federal Reserve, where you would have thought, having been burned, they would have focused on it. But there's not as big. This is an area of research which has been much more active here in Europe than in the United States. On the first question, what can if you're a billionaire, what should you do? There are a couple answers to that, and there are several of them who are actually been engaged in trying to do something and actually spent significant sums. One of them is political. You know, in the end, it is a political process. There is a social cost of carbon. Individuals don't pay that social cost. And it's going to be a political process to force, to make people recognize it's a social cost. It's really almost that simple, that you need to have a price on an externality, if you want to think about that, something that's a social cost. And it's a political process, and there are those who benefit from not having a price, and they are very strong in advocacy. People, you know, like Exxon, spend a lot of money trying to convince people that climate change did not exist. And the interesting, just as a side, there is a major suit of Exxon saying that it, in its own research, had validated that there was a problem of climate change, and by hiding that, they were acting in a way that violated their fiduciary responsibilities to shareholders. And so there's in New York, there's been a suit filed against Exxon on that basis. And that is a second strategy, which is legal hassle of those who are not behaving responsibly. As I say, I can't underestimate the importance of this as a political struggle. And with people whose vested interests are to keep a zero carbon price. And one has to recognize that there are distributional consequences. You know, that there are people who own carbon assets, that those prices, when we said the carbon price, the prices, their assets are going to go down, or going to adjust, some of them are going to go down. And if you have one of those assets, you might not want that to happen. So it is not a surprise that there is opposition to this. The second thing is somewhat symbolic, but I think it will have more than a symbolic effect, which is divestment. You know, they own a significant amount of resources, and if they allocate those in ways very publicly that they are not owning those carbon assets, it creates pressure. And that's why I think universities should divest themselves of coal, and many of them are beginning to do that. I think there's a broader task related to the political, which is one of enhancing public understanding of the consequences of climate change and the risks. You know, as I put it in one of my books, you know, if we had 1,000 other planets and we happen to make a mistake with this planet, we could go on to another one. That would be one thing. But there isn't another planet. So once you realize that should affect your attitudes towards risk-taking. That you probably don't want to take a big risk with this planet. And that should affect, you know, what kinds of policies that you can push. The final question had to do with had two parts. One of them is, I think it is important to, you know, there's been a debate about will putting a price on carbon slow down economic growth. Will we pay a high price for having to have a carbon price? The first part of my talk was explicitly trying to argue that actually, given the world's current situation of a weak global economy, we would actually benefit from having, the global economy would benefit from a carbon price. It would actually stimulate it. But there's a broader point I want to make, which is the following, that GDP is not a good measure of economic performance. And I've written a little book with this commission on the measurement of economic performance and social progress called Mismeasuring Our Lives, Why GDP Doesn't Add Up. And the point is that, Robert Kennedy once gave a famous speech where he said, GDP measures everything in life except that which is important. The point is that GDP is not a good measure of economic performance, and if you have a GDP and the economy is not sustainable, there's environmental degradation, resource depletion, all these other things, then GDP is not what you should be caring about. And we've developed better indicators which reflect better what is really going on. So I think we are often misled by GDP measures to a false choice, that if we had the correct metrics, we would say even more clearly than my first, that actually imposing a carbon price would actually improve economic performance correctly measured. But the question was asked, well, how do you prevent people from speculating on GDP? On a better measure, on a measure of carbon footprint or a measure of any other measure of environmental degradation. Let me say, I think it really is important to have these measures because what you measure affects what you do. And if you have the wrong measures, or if you don't measure it, you won't do anything. But just as a side point, under President Reagan, President Reagan was an initiative to stop the measurement of poverty. It wasn't that he thought by stopping measuring poverty, poverty would go away. But what he thought is if you don't measure it, nobody will pay any attention to it. So he argued very strongly that, he tried to defund poverty statistics. Well, it's the same thing. I think that's why it's important to have these metrics of what's happening to our environment and climate change, because by measuring these things, we are more likely to pay attention to them. But the question was, if we have these measures, won't there be people gambling on them? Well, the answer is, yes, it's probably the case, but they're going to gamble on something anyway, and at least if they're gambling on it, they'll pay attention to it. Just as a side point, in Beijing, the U.S. Embassy puts out a measure every day of how unbreathable the air is. And the Chinese government tries to shut down the website and make it not accessible so people won't know how unbreathable it is. But you just go outdoors and you start to cough and you realize how, you can't see your fingers in front of you. You know the air is not very good. But anyway, the point is that even if they were to make a gamble on it, it's probably not a good thing, especially when they lose money and gamble somebody is going to lose. But the fact is that's not the more important issue is it's better to measure it so that you can start focusing on it.
Let's try to take one more question if it's quick. Yeah, and by the way, my former postdoc who went back to Beijing told me that the index that is used to measure the unbreathability of the air is the number of cigarettes, equivalent number of cigarettes that you would be smoking if you are walking outside in the street for 3 hours. So every day, the index is how many packages of cigarettes have you, equivalent package of cigarettes have you smoked today? Alex.
Yeah, so my question has several drawers. The first is, how would you get the level of the carbon price right? Then at what speed should you try to get it to the right level, given that there is potential for crisis, as you mentioned? And then would you do one worldwide price, or would you do pricing, say, by country?
Well, the nature of global warming is that it's a global phenomena. And the social cost of carbon, the molecules don't know that they need passports when they go from one country to another. And we haven't figured out a visa system to make sure that the carbon emissions in the United States stay right above the United States. Okay, so it is a global problem. So I feel very strongly that there should be a single price of carbon for all uses for all countries. And this leads to the second. The issue of carbon is a issue not of the flow but the stock. It's the carbon concentration in the atmosphere that affects global warming. We often focus on the flow of emissions, but what we really concern is this, the stock variable, the CO2 concentration. And that means roughly you should have the same carbon price at every date. So my view is you should go right away to a high carbon price. And yes, there will be stress, and that may necessitate some bailouts, if it's done carefully, some transitional assistance, but it's more important in my mind to get a clear signal that there is a real social cost that we've been subsidizing for a very long time, and we should do it right away, recognizing that there are some risks on the financial sector in doing it. So the point of the kind of network analysis that I described is to let you be aware of where you will have to be attentive for intervention, but not to slow it down. Now, the issue, the more difficult issue is how do we know what the right carbon price is? And the answer is we won't know for sure. This is sort of intrinsic uncertainty because we don't know either with precision. We know something. We know what the level of carbon concentration will trigger what change in temperature, and it's not just climate change, it's not just temperature, it's a whole variety of climate consequences like weather variability and ocean consequences. You know, raising ocean, acidity of oceans. So there are a whole variety of social consequences that we don't know fully, nor do we know precisely the responsiveness of markets to this, so that we don't know. It could be that a relatively low carbon price would induce very large responses in carbon emissions. So we don't know that with precision. But we know, we actually have a fairly good idea of each of those parameters that I described. So that gives us the basis for an estimate of what is the best estimate of a price. We may be wrong. We know we will be wrong. But that only implies that we will have to adjust it as more information comes in over time. So to me, I view this as an iterative process where we will constantly be readjusting, reevaluating the number, and seeing how the market responds. And just to give you one example, it may be that we will all of a sudden innovate in ways that will mean that we will be able to sustain a low carbon economy with a very low carbon price. And that would that kind of technology change would mean that the equilibrium carbon price would be changed. Anyway, the real point is, I think, the perspective that we ought to recognize that we will have to constantly be recalibrating this, and that will be a politically unpleasant fact, because it would be nice if we had the kind of precision that would say that we know today what the price ought to be for forever. So, and we aren't going to be able to adjust it smoothly as we can, but we have to do the best we can.
Good. Actually, you said before this, you made this comment about Exxon and the geologists that like to have, that it's no fun if you cannot drill new oil wells. And it actually resonates with, 2 weeks ago I was talking to someone very close to Shell management, and they were telling me, I mean, these are at very top, and they were telling me that one of the problems there is that their corporate culture is actually that they feel their mission as we are good at drilling. And that's a very interesting coincidence. So now the question is, would the energy sector, do you think that at least part of the energy sector would be able to turn themselves into a different corporate mission? We have examples of that. IBM have changed entirely their business model and corporate mission. So would they all slowly die out in the next 20, 30 years, or do you think that some of the energy sector will come the new entrants?
I think that many of the oil, I don't know all of them, but some of the oil companies at least, have been engaged in thinking and answering precisely the question that you asked. What is their, you might say, core competence, to use business jargon? So what some of them say, look at, we are good at, some of the ones that are good in offshore drilling, saying we know how to put up windmills offshore so that we will go into producing energy, offshore energy, but rather than through offshore drilling, we'll do it through offshore windmills. I mean, whereas others think of themselves as they're, trying to think about what it is that they've been doing in the past that is relevant in a world of a high carbon price. And obviously, each of the companies has different competencies, so there's not always, the answer will be different. Some of them probably should shut down for a whole variety of reasons, including ethical reasons.
Okay, so I think it's time to close. I would like to, first of all, thank you to be here at the University of Zurich. Thank Joe again for his visit to our university and our department. So I'd like to ask you to join me in thank Joe again with a big applause.